Centrelink is receiving updated information about your superannuation balance twice a year without you doing a single thing. That is not a rumour, that is the law. And for many older Australians, it is quietly reducing their age pension payments without them even realising why. If you have a super balance that feels a little too healthy, or if you have ever wondered whether Centrelink can actually look into your account and cut what you receive, stay right where you are. Because in the next few minutes, you are going to understand exactly how this system works, what Centrelink can and cannot do, and what the latest 2026 figures mean for your pension payments. Welcome. Here at Centrelink Pension Bulletin, we make it our job to explain these rules in plain, straightforward language so that you always know where you stand and never get caught off guard. Let us start with the question everyone is asking. Can Centrelink actually check your superannuation account? The short and honest answer is not directly, in the way you might imagine. Centrelink cannot log into your super fund's website and browse your account like you do. They do not have a live window into your personal balance at any moment of the day. But here is what they can do, and this is the part that surprises most people. Your super fund and life insurance companies are required to provide updated information to Centrelink twice a year, around March and September. This helps Centrelink accurately apply deeming rules to your balance and understand how your super is being drawn down. This is not optional, it is a legal requirement. And those updates can directly affect how much age pension you receive. So twice a year, without any action on your part, your super fund is quietly reporting to Centrelink. Many pensioners are completely unaware this is happening, and when their balance changes, even slightly, it can flow through to a change in their fortnightly payment. That is why staying informed is so important. Now, before we go any further, here is something that many people get wrong. They think Centrelink only looks at how much income you actually earn from your super, but that is not how it works at all. And this misunderstanding costs some retirees real money every fortnight. There are two tests at play here, the assets test and the income test, and your superannuation counts in both of them. The balance of your super account is counted in the assets test, and an estimate of how much your super investments earn, known as Deeming, is counted in the income test. So your super balance affects you in two ways at once. First, it counts as something you own, an asset. Second, Centrelink assumes it is earning you a certain level of income, whether it actually is or not. But first, Matilda, here is something worth pausing on. If your partner is under 67 and has not yet reached age pension age, their super balance is generally not counted in the assessment. But the moment that younger partner reaches 67, the rules change completely. Their super comes into the picture and your combined entitlements may shift. This is one of the most overlooked timing issues in retirement planning, so keep it in mind. Now, let us talk about the assets test, because this is where super balances can have a very direct impact on how much you receive. From 1st July 2026, the full pension is available for homeowner singles whose assessable assets are under $333,000. For homeowner couples, the figure is $499,000. For non-homeowners, the full pension thresholds are $600,000 for singles and $766,000 for couples. If your assets, including your super balance, are below these figures and you pass the income test as well, you should receive the maximum rate. But what happens above those thresholds? Your pension does not just disappear, it reduces gradually. The pension reduces by $3 per fortnight for every $1,000 over the limit. That works out to $78 less per year for every $1,000 above the lower line, and that adds up quickly. Let us use a simple example. Imagine you are a single homeowner. You have $500,000 in your super fund and $50,000 in the bank. Your total assessable assets would be around $550,000. That is $217,000 above the full pension threshold of $333,000. At $3 per fortnight for every $1,000 over dollars, that is about $651 less per fortnight than the maximum rate. That is a significant reduction. Now, here is something you might be wondering. At what point does the pension stop entirely? A single homeowner with assessable assets above $733,500 receives nothing. For a homeowner couple, that upper cutoff is $1,102,500 combined. For a non-homeowner couple, it extends to $1,369,500. These figures are updated 3 times a year, so always check the latest numbers. Now, remember we mentioned deeming? Let us explain how that works, because this is the part that catches people completely off guard. Centrelink does not care what your super fund actually earned last financial year. Instead, they apply assumed rates of return, called deeming rates, to all your financial assets, including your super balance. The deeming rate freeze ended on the 30th of June 2025. The new rates took effect on the 20th of March 2026. The lower deeming rate is 1.25% on financial assets up to the threshold. The higher rate is 3.25% on everything above. For singles, the threshold is $64,200. For couples where at least one person is on a pension, it is $106,200 combined. These rates went up in March 2026 after years of being frozen at much lower levels, just 0.25% and 2.25% respectively. So if your super balance is significant, more of it is now being deemed at that higher 3.25% rate, which increases your deemed income, and that can reduce your age pension noticeably. Let us walk through this slowly. Say you are a single retiree with $400,000 in super. Centrelink deems the first $64,200 to earn 1.25%, about $803 per year. The remaining $335,800 is deemed at 3.25%, about $10,913. Your total deemed income from super alone is approximately $11,716 per year, or roughly $451 per fortnight. That deemed income is then added to any other income you have, and the combined total is assessed against the income test thresholds. For singles, the income threshold is $218 per fortnight before the pension starts to reduce. For couples, it is $380 per fortnight combined. If your income exceeds these limits, your pension is reduced by 50 cents for every dollar above. So, with $451 per fortnight in deemed income from super alone, already above the $218 single threshold, you can see exactly why a higher super balance leads to a lower pension. And that happens even if your super fund actually earned less than the deemed rate. Centrelink assumes those returns regardless.
What if your super is doing badly? What if the market is down and you are not actually earning 3.25%? Can you ask for an exemption? Deeming exemptions are rare and narrow. You cannot get one simply because your investments are performing badly or your shares have dropped in value. The Minister for Social Services is the only person who can grant an exemption, and only in very specific circumstances. You are assessed on the assumed rate, not the real one. This is one of the frustrations many retirees feel, but it is the law as it currently stands. Now, what about withdrawing money from your super? Some people think that taking a lump sum out will help reduce their assets and boost their pension. That can be true, but it depends entirely on what you do with the money afterwards. If you spend the money on a holiday, home renovations, or medical costs, the money is gone and your assets go down. But if you simply move it from your super account to your everyday bank account, nothing really changes. The money is still counted as a financial asset. It is still deemed. Your pension may not change at all. And if you decide to give money to your children or grandchildren to reduce your assets, be very careful. Centrelink has strict gifting rules. There are limits on how much you can give without it counting toward your assets test. We will cover the gifting rules in full detail in a future video, so make sure you are subscribed. Your family home, no matter how much it is worth, is exempt from the assets test. Whether your home is worth $400,000 or $1.4 million, it does not count. This is why the thresholds are set lower for homeowners than for non-homeowners.
it is one of the most valuable exemptions available to Australian retirees. Now, what if you have not yet retired? If you are below pension age, currently 67, your super balance generally does not count in the income or assets tests as long as your fund is not already paying you a pension or income stream. Until you turn 67, your super is largely invisible to Centrelink. The moment you reach pension age, that balance comes into full view.
Many people also ask, can Centrelink log into my bank account directly? The answer is no, but they do receive regular data updates from your super fund twice a year, and they rely on you to declare your assets and income accurately. You also have an obligation to keep Centrelink updated if your circumstances change significantly between those reporting periods. Is there anything you can do to lawfully manage the impact of super on your pension? Yes, but this is where you really need to speak with a qualified financial advisor who specialises in retirement and Centrelink rules. Some strategies worth exploring include the timing of when a younger partner's super comes into assessment, or looking at the government's Home Equity Access Scheme if your pension has been reduced significantly. Always get professional guidance before making any moves. The wrong decision could trigger an overpayment that Centrelink will ask you to repay. Here is the good news. You do not need to have zero in super to qualify for the age pension. You just need to understand where your numbers sit in relation to the thresholds and keep Centrelink updated when things change. To quickly summarise, Centrelink receives your super balance information twice a year, in March and September. Your super affects both the assets test and the income test through Deeming. From July 2026, the full pension asset threshold for a single homeowner is $333,000, and for a homeowner couple, it is $499,000. Deeming rates are now 1.25% on the first portion of financial assets and 3.25% on the rest. Withdrawing from super only helps your pension if you actually spend the money, and your family home is always exempt no matter its value. These rules change regularly, which is exactly why we are here at Centrelink Pension Bulletin. If this video helped you today, please give it a thumbs up and subscribe so you never miss an update. Leave your question in the comments below. We read every single one. Coming up very soon, the gifting rules. How much can you give your children or grandchildren without Centrelink counting it against you? The answer might surprise you, and getting it wrong can cost you dearly. Make sure you are subscribed so you catch that one the moment it goes live. We will see you there.